And we continue to idle in these markets since Wednesday last week, when everybody was so very happy that US inflation has decided it will resume going down, having basically stalled all through the first quarter of the year. Will we finally get someone to wake these markets up as the week progresses? That's the question that we are going to tackle here on Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And it's not the biggest week for macro event risk or any kind of event risk for that matter. But we do have something of a focal point, and it comes at us in two flavors over the next 24 hours. Then, of course, we get into the gravitational pull of a shortened holiday week next week in the US, which is going to drain a bunch of liquidity from these markets as US bourses stay shuttered for Memorial Day. But before then, a bit of a crescendo. So the question that we're going to ask ourselves here is, will FOMC minutes from the fateful May meeting and the first quarter earnings report from NVDA finally rouse some sort of a decisive move? So first, let's get a little bit anchored in how we got here and what's been going on to land us where we sit, and what's been happening or not happening as it happens since that occurred. So last Wednesday, just a little over a week ago today, US CPI data comes out, and the response is, as we can see here, unmistakable. Stocks rise, bonds rise, yields fall. Crude oil continues to do its own thing as though it exists in a vacuum, but gold is up, the dollar is weaker. And to put a real fine point on the idea that all of this is positive for risk appetite, Bitcoin rises 7.5% in a day. So very clearly here, the markets saw the CPI data, last week's sort of tentpole release, and said, good, we like this. What did they see? CPI data came out exactly in line with expectations. There was an expectation that the core would go to 3.6%. That is a 3-year low. It did. There was an expectation that the headline would tick down from 3.5 to 3.4, coming off the sort of top of this congestive range that it's been in for a good bit of last year. That occurred. And so all seem to be generally positive, at least for markets that were concerned that what may happen is another month of sticky inflation that gets the Fed spooked and gets rate cuts pushed off the table for the year. If we look at the change in these underlying components, so the contributions and then also the change in those contributions. Note here, of course, before we jump over to that next chart, at this point, goods inflation is actually negative. Put that in the context of the recent announcements we've been seeing from the likes of Target, where they are cutting prices on, in Target's case, 1,500 of their SKUs. So and this is certainly not in isolation. Other big retailers have done similar things and announced similar things. So on the goods side of things, it actually looks like inflation is going in a very positive direction, in the sense that, at least for the consumer, prices are falling when it comes to goods. Needless to say, not so services. Energy has also become a little bit of a positive contributor once again. And food inflation has been generally unchanged. It's had a big upswell here in the immediate aftermath of COVID reopening and has now basically returned to what was broadly normal sort of contributions. We can see that there's comparable contributions from food here and here. So it seems like normalization has finally occurred. When it comes to goods, it seems like things are actually still adjusting. When it comes to energy, it was a big negative contribution that has now essentially rebased to something a little bit more normal. So, with that, the change in the contributions from month to month is decidedly encouraging. First of all, of course, the headline comes down. The core comes down more, and this is, of course, the part that the Fed is most interested in because there is nothing they can really do to move global energy prices. There's nothing they can really do to move global food prices. Those costs are essentially baked in. The markets are going to do with that what they will. Where the Fed has actual agency with policy is in the core side of things, so excluding food and energy. And as we can see here, where the inflation now lives is in services. So when you look at these changes, first of all, it is tremendously encouraging that the core had the bulk of the decline, offset, as we can see here, a little bit by what's going on in energy. And that services was where most of the disinflation occurred. Not surprisingly, the market liked it and said, oh, good. This means the Fed can still cut rates. The progress that they've been looking for has been reasserted. But what's happened since then? Not a whole lot of anything. The S&P 500 is essentially flat. The NASDAQ is only doing a tiny bit better, up about 40 basis points or 0.4%. Bond yields are actually up and have erased nearly all of their CPI decline. As a matter of fact, the 2-year has had a bigger move. That's the one that's the more sensitive to near-term Fed policy odds than has the 10-year. So whatever optimism there was to be had, whatever happy thoughts there were to entertain as bond yields fell when the CPI data came out, well, that's been erased now. Crude oil continues to do its own thing. Gold is a touch higher, but the dollar is back on offense, up a little bit against the euro and up a little bit more against the yen. Bitcoin's still tracking higher and suggesting that the overall setting of risk sentiment remains relatively well supported, but the makings of what looked like a CPI-inspired burst of optimism related to the Fed's ability to deliver some amount of stimulus this year, that is very clearly showing a lack of conviction here, at least for now. Follow through, at least in a kind of decisive way that appeared when CPI initially came across the wires, has been clearly absent. We can see here that when we look at the makings of what has actually occurred, the actual calculus for Fed policy odds really hasn't changed very much at all. We were at about 35, 36 basis points before CPI. We got to 41 basis points right here, that little bit right there, when CPI came out. That was this pop in the S&P. And we're now back to 34 basis points. So we have essentially done nothing. In fact, by a very slight margin, we are actually a little bit less dovish now. than we were before CPI numbers came across the wires. It's a negligible amount. It's maybe 1 or 2 basis points. But what this highlights is the markets didn't exactly run away with some sort of a new paradigm once these numbers came out. And there is perhaps a reason for that. If we look at what the Fed monitors here, and this is the sort of annualized view of near-term price dynamics that suggests perhaps where disinflation is actually trending. So on the bottom, we can see that month-on-month changes in CPI are very helpfully getting smaller. Month-on-month changes in core CPI are helpfully getting smaller, although not surprisingly at a more flat sort of incline. That's sort of the point, really, with core CPI is you remove volatile things like food and energy and you smooth things out a bit. So you can see the upswell in headline inflation was more dramatic than was the same thing in core, and same thing on the way down. But at least the trends seem to be generally supportive. But look at what's happened in April with the annualized 3-month and 6-month trends. The blue bars here, the 3-month trend in CPI headline, actually higher from March to April. The 6-month, higher. The core 6-month, higher. The only place where we get a little bit of a reprieve is the core 3-month annualized average ticks down a bit. Now, this feels like minutia, but consider, what has the Fed been saying? We need to see more decisive evidence of disinflation in order to consider rate cuts. Well, does this look like decisive evidence that gets the Fed to cut rates in a more significant way? Doesn't seem so. Does it seem like we are getting to a place where the Fed can, when it adjusts its official forecasts in June, just about a month away now, stick with a call for 3 cuts? Maybe not. And so there seems to be some trouble here lurking under the surface of what appeared to be encouraging headline and core numbers at the year-on-year sort of most watched version of the metric. Which makes the next 24 hours interesting, because what we're going to get is the release of minutes from the May meeting of the FOMC, the Fed's policy setting committee. Now, importantly, this is not a strict stenographer's retelling of exactly what was said. Rather, this is a kind of editorialized summary. And of course, the Fed fully understands and is completely self-aware that this is an opportunity for the markets to shape expectations, and that what they say here in this document might, if it strikes an emphatic enough chord one way or another, move markets, change expectations, and so forth. With that in mind, the Fed has an opportunity here for a bit of jawboning, for a bit of forward guidance, for a bit of a turning of the knobs of expectations, as it were. And so we know already from the policy statement that Fed officials in May were frustrated that disinflation seemed to have run aground. And we know that the commentary that we've had from policy officials since even today has been much more hawkishly tinged, much more reluctant to say that inflation has started to move lower again in earnest, much more reluctant to take the possibility of rate hikes off the table. We also, of course, know that in the press conference after the policy announcement, Chair Powell was pointedly asked whether the current setting of policy was restrictive, and he said, we think it's restrictive and it will become restrictive enough, which is to say it's not restrictive enough now, clearly, because disinflation has stalled. At that point, we hadn't seen the CPI numbers yet. And as we can see from this screen here, they felt like they changed something, but perhaps they did not change all that much. And the market's subsequent standstill perhaps speaks to this. So these minutes may well end up being spicier than just a retelling of what the markets already know. If they signal a building constituency in favor of hiking rates, or at least in favor of putting that back on the table as a equally likely set of policy outcomes to doing nothing, to cutting at least once, if there is a diminished resistance to resuming rate hikes on the FOMC, that would paint a very different story for risk sentiment than the CPI numbers suggested, and would likely be negative for stocks and would likely be positive for the US dollar. And of course, an additional caveat in this entire story is that against the backdrop of what may be perhaps a diminishing case for confidence in the Fed's dovish inclination, is that the global growth picture has actually meaningfully deteriorated alongside an even more pronounced deterioration in the US for basically the past month or so. When rate hikes were occurring, there was, of course, the expectation that the economy would slow as a consequence. At least in the US, it proved to be surprisingly resilient. So when the year started and rate cuts now started to fall out of the forecast, you can see that right here. Here's the beginning of the year, and we can see the markets enter the year thinking the Fed is going to have to be much more dovish, because now that they've actually, as of November, said, yes, we agree it's time to stop hiking and it's going to be time to start cutting, the market said, well, they must see some sort of terrible economic outturn around the corner. 6 cuts. But then what actually occurs, we can see it right here, since the beginning of the year, U.S. economic data actually starts to reaccelerate relative to forecasts, according to this data from Citigroup. And so what we then find is the markets are perfectly okay with that version of events, because they say, well, these rate cuts are going away for good reasons. And in any case, the Fed's benchmark is 3, and we're slowly going from 6 to 5 to 4. Only when the markets become more hawkish than the Fed, only when the Fed reiterates in March that they want to be at 3 cuts for the year, and the market goes, no, you're more like at 1.5 or 2, do stocks stall. And then, of course, subsequently come off until this too is anchored and baselined. Well, the difference now is that while the rate cuts were going away for good reasons in the first half of the year, and since then things were borderline stable, what has now happened in the second quarter is a rapid deterioration in U.S. data outcomes that has seemingly bled into slowing global outcomes for economic data as well. And so if the Fed is reluctant to cut rates now, it is reluctant to give support to an economy that's turning in an adverse direction. And that, of course, just adds insult to injury. and makes any kind of reluctance to deliver stimulus that much more painful sounding when it comes to stocks, and that much more supportive when it comes to the dollar. We'll see, of course, if that's the way that the markets choose to interpret the Fed, and if that's something that can even plausibly come out of what the Fed signals here. But some of the recent Fed speak certainly appears to suggest that the committee is not nearly as dovish as the markets may have hoped for when CPI came out. And then the wild card is, of course, the first quarter earnings release from AI darling NVIDIA. And here, a kind of sentiment perspective might be in order. So if we take a look at the expectations, of course, we're looking at an EPS of $5.6 and a revenue estimate of almost $24.6 billion. But what seems to be the most important here is the level of speculative ardor around the AI story, for which NVIDIA is essentially the avatar, to see how much speculative fervor actually remains and what, quote unquote, good looks like. Now, if we look at what happened last year, you can see that here, the average surprise relative to expectations for NVIDIA earnings is something on the order of 25, 26%. That is, of course, a staggering gap. We can see it with the naked eye here. So when we look at this, the question is almost less about will NVIDIA surprise higher or will it surprise lower? They seem to have been very good at guiding such that they can beat. Kudos to them. But if the market is starting to benchmark what normal is, and the surprise magnitude is less than what the markets are used to, dare I say, even in the single digits, the speculative momentum perspective on this may be that the narrative is cooling. And there might be a buy the rumor, sell the fact kind of a response, where the market says, yes, maybe NVIDIA does beat. But if it beats by a narrower margin than has been normal in recent quarters, the momentum behind speculative fervor may well deflate. It's a similar story when we look at the revenue side of the equation. Again, massive outperformance in the first half of last year, and then a kind of easing. Now, here, of course, the averages are not as pronounced, but nevertheless, we're talking about revenues here that, for the most part, last year, were beating in the double digits. We cooled back to somewhat modest, I guess we can say, relative to history, 8.4% surprise for the fourth quarter. That would be the narrowest surprise we'd seen since the tail end of 2022. And again, the story here is analog. If it seems like the markets are starting to get more comfortable with what normal is, and the surprise is something like 4%, 2%, something that meaningfully comes off last year's heady numbers, not in aggregate terms, but in relative terms. Outcomes relative to forecasts. Again, there may be a speculative draining of momentum. And that may be enough for markets that are struggling to find direction after what was a mixed CPI report to disperse a bit, especially with a U.S. holiday on the horizon and liquidity getting thinner. So although tomorrow may not bring any staggering revelations. In relative terms, it may be something of a sentiment peak, at least for the near term. And that is macro money for today. As ever, we are here Monday through Thursday after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what it might mean going forward. I'm back on with Chris on Fridays for Futures Power Hour. On with Victor Jones for his great new show, The Price of Truth, on Wednesdays. Back on with Victor and Tom for First Call on Sundays. Writing for the news and insights portion of tastylive.com and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money's back tomorrow. See you then.